Hi learners, I'm just going to explain this activity quickly. As I can see that it is challenging, right? So we are dealing with accounting records of FF stores on 28 Feb 2011. Okay, they gave you the balances that remember that a debtors control, it is an asset, right? So this is what is remaining, or what this account has at the end of the year. And then we have the provision for bad debts, which is a negative asset. So this is what we currently have in this account of provision for bad debts, 2000. And then we have this expense, and this is what is on in this expense for this financial year. Remember that expenses, we actually close them off to profit and loss. So this amount relates to actually this financial year, right? So let's do this adjustments, and then after that record them on our accounting equation, or rather show the effect on the accounting equation as well as our ledger account, right? So we're only opening 4. So we are told that debtor B. Brown was declared insolvent. He owed 500 rand. His estate paid a final dividend of 40 cents on the rent. This transaction was not recorded. So this dividend part, you'll do it next day, grade 12. But what you should know is that we have a debtor who can no longer pay. Usually when they only gave you this statement until here, it means you have to actually write it off, right? Write this whole 500 rand off. But you cannot write this whole 500 off, because you are told that, okay, his estate was able to actually pay 40%, which is 40 cents of this 500 rand. And this transaction was not recorded, right? So you need to find out how much was paid from this 500 rand, because you are not going to write the full 500 off, and also find out from this 500 how much it's still outstanding, so that you can write it off, right? So let's look at for the amount that was paid. Amount that was paid, I've already done it, is 200 rand, right? So now remember that for each transaction there has to be 2 accounts affected. So if amount was paid directly into our bank account, if we received money, usually the first account which is affected always is what? It is the bank account, right? Now this 200 rand was paid towards what? It was paid towards Mr. Brown's debt, which is debtors control. So therefore it is also what? It is also debtors control, right, of this 200 rand, right? So now you need to find out which account was debited, which account was credited, right? Okay, so when we have received something from this bank, from this asset, right, asset, they're going to actually increase, right, on which side? On this side, on the debit side. So therefore we are going to debit this account, right? And then since this person's debt, Mr. Brown's debt, is decreasing, and debtors control, it is also an asset, you need to now determine asset, they decrease on the credit side. So therefore you are going to debit this account and credit this one, right? So therefore it will be transaction number 1, it will be bank there, right? It will be bank there, as well as what? As well as debtors control. Debtors control. And whenever debtors control is affected, you should know that it means you are going to have to adjust that amount when you do your provision for bad debt. So the amount here is 200 rand, and then since your bank, it is an asset, right? So I was supposed to say amount here, amount, and then this will be asset, this will be owner's equity, and then this will be liability, right? So this, since a bank, it is an asset, so therefore assets are increasing because we are receiving cash, right? And then since debtors control, it is also an asset. What does that mean? It means since this person, or since this estate paid an amount, the debt is decreasing, and the debt decreases on the credit side. So this minus, you just put it here and say, okay, under my assets, right, bank is increasing, debtors control is decreasing, right? And then after you have determined the amount that was paid, you need to know what was not paid, right? The remaining debt. That's what you need to find out. The remaining debt, right? So he owed a total of 500 rand and they paid how much? 200 rand. What is left? It is 300. Since this person was declared insolvent, it means this person can no longer pay, right? They can no longer pay, and therefore we need to write them off. If someone can no longer pay us, there's nothing that we can do. We just write this person off to bad debt, right? So therefore this 300, it means two accounts will be affected for this transaction. So it will be first, what you have been dealing with, bad debt, right? And you would have what? You would have debtors control again to say, I'm going to remove this from my debtors control because we can no longer recover this person. So your bad debt is what? It is an owner's equity expense. Owner's equity expense, right? So we know that owner's equity, they decrease on this side and increase on this side. But expenses, remember, expenses are always debited because they decrease the profit, right? So therefore, this bad debt will be debited, right? And then let's look at debtors control. Since we are actually removing this person from our debtors control, it means we're gonna say this, since debtors control, it is an asset account, it decreases on this side because we are decreasing our debtors control and taking it to bad debt, right? And expenses, they increase on this side, so therefore it will be credit, right? So this is how the transaction will look like. And then you go back to your accounting equation and say, which account am I debiting? It is my bad debt, right? Because it is an expense, they increase on the debit side, so it is my bad debt. And then which account am I creating? It is my debtors control. For how much? For 300 rand to make it 500. And therefore you ask yourself again, bad debt, it is an expense, and we know the sign should be a negative, showing that it's gonna decrease the profit, so therefore it's gonna be a minus there. And then debtors control, it is an asset, and we had to decrease this asset of ours to say this person can no longer pay, so therefore you'd say minus again, and then it will be 0 and 0, right? Okay, then we are done with transaction number 1. You go to transaction number 2, right? So transaction number 1, you're done with it, we have recorded it. Transaction number 2 says this transaction, they relate to trading stock and they were not recorded. Very important statement, not recorded. The credit sales of merchandise. Sometimes accounting may put the statement, right? In accounting, they may put the statement and say this transaction was recorded. Okay, so if this transaction was recorded, it means you wouldn't do anything to it. But now that they're saying this transaction was actually not recorded, right? So this is a very important statement. So credit sales. So remember, for us to incur bad debts, right? It's because we sold on credit, right? So since we sold on credit, this is going to affect our debtors control, right? So when we sold on credit, which accounts are affected? When we have sold on credit, not 2 accounts are affected, but we have 4 accounts which were affected, right? So we have our debtors control, right? As well as our sales, right? And look at this end, right? These 2 accounts, they affect each other, as well as what? As well as our cost of sales and trading stock, right? So when there's a sale and a credit sales, there are 4 accounts affected. It is your debtors control with sales and cost of sales with trading stock, right? So your debtors control and sales, it's usually the selling price amount, and in this situation it is 800, right? It is 800, and then in this situation it is how much? Yes, it is the selling price of 800. And then for cost of sales, for trading stock, remember when we record trading stock at its cost price, right? So you look for the cost price there. If it is not here, it means you would use your profit markup, right? So it is actually 600, right? So you need to know the effect on the accounting equation, right? So let's look at this 2 first. Debtors control, when we have sold on credit, right? It is an asset account. What does that mean? It means our debt, okay, or rather what is being owed to us increases. Our debtors control account is going to increase, so it's plus there, and then it's minus debit, credit, right? And then, so therefore, since we have sold on credit, it means the debt is increasing. The debtors control account is going to increase. This is a plus to it. And then we have a sales account. So for sales, sales is an owner's equity income account, right? It's owner's equity income, right? And we know it's minus and plus on this side. We know that this is actually a plus on this side, even though we have not received the money yet, but we know that the plus just means that the profit increases, right? It's going to increase. So therefore, this account will be credited, right? So this will be debited, right? Because this is a plus, and then this will be credited because the plus is on that side. To say our sales are as well increasing, therefore they're going to increase our profit. And then you record this to say the debit is debtors control, the credit is sales. So it is debtors control as well as sales. For how much? For 800 rand. Remember, we record the debtors control account, we plus it with the selling price, right? So therefore, the debtors control, it is an asset and it is increasing. The sales, it is an owner's equity expense, and then it expenses the increase on the credit side, right? So it's plus here and then plus here and then zero there, right? And then we have other two accounts affected as well in this situation. We have the cost of sales and we have the trading stock. When we sell stock, what happens to our stock? Our stock is going to do what? Our stock is going to actually increase because trading stock, it is an asset account, right? So our stock is going to increase. It's going to increase. Oh, my apologies. Our stock, when we have sold, our stock is going to decrease. Okay, our stock is going to decrease to say we have sold stock, therefore our stock decreases, right? So therefore this account trading stock should be credited, right? And then your cost of sales, okay, cost of sales, since this account is debited, this account will be, since this account is credited, this account will be debited, right? Cost of sales, it is an owner's equity expense, right? So since this account is credited, remember your double entry principle. It means therefore we are going to debit this account. So therefore it's cost of sales and trading stock, right? So it's cost of sales. Since it is an expense, of course we debit our expenses, cost of sales as well as trading stock. Because trading stock is actually decreasing when we sell, right? So we actually record trading stock at its cost price of 600, right? So our cost of sales, it is an expense, therefore owner's equity, it is a minus. Trading stock, it is an asset, and our asset is decreasing as we sell this stock, so therefore it is a minus, and then it is a zero there, right? And then you are done with this transaction. You have a second transaction there which says what which says that there's actually a credit note which was issued. Okay, so a business issued a credit note when what has happened, right? When a debtor decides to return goods, right? If this person has purchased on credit and they decide to return the goods, right? When they return those goods, right? We as a business, we are going to do what? To say, okay, a debtors control, it is an asset account, right? It increases on this side, debit side, and decreases on this credit side. So when the debtor returns stock, right? This is the account, right? So that means that their debt is going to increase, and therefore we are going to issue what we call a credit note. So the term credit comes from this account saying when we give that person a credit note, we are actually decreasing their account, right? So whenever that you see a credit note was issued, it means that we have to actually decrease this debtors control account, or rather one of the debtors actually returned the goods that they purchased, right? So this is actually a debtors allowance, right? So of 400 rand. When a debtor has returned stock, Same as when they have bought stock. There are 4 accounts which are affected, right? So we also have debtors control to say debtors control has to be affected. Why? Because this person is retaining stock and therefore their debt is going to decrease. We also have sales to say, okay, our sales have to decrease because they are no longer the same. Okay, we cannot say we sold this much when a person has retained, so this account also needs to decrease, like, right? And also we have what? We have our cost of sales as well as our trading stock, right? So for trading stock, remember that these persons, they have returned stock, right? So this is going to affect our trading stock, right? So it means the trading stock is going to increase, right? So looking at debtors control, let's look at the effect, right? So debtors control, since this person has returned stock or we have issued a credit note, it is an asset account again, so it's plus on the debit and then minus on the credit side. So therefore the debtors control account has to decrease because stock is being retained, right? So therefore we are going to credit debtors control. For sales, it is an income, owner's equity, right, minus plus. So sales increases on this side, right? So to reverse this transaction, to decrease this sales account, it means you are going to have to actually do what? Debit it, to say it is now decreasing, right? So therefore for this one, the one that is debited is sales and the one that is credited is what? Is your debtors control. And you always take the selling price, and the selling price there is how much? The selling price is 400, right? So the selling price there would be 400 rand. So it is 400 rand. We are going to debit our sales, right? And then we are going to credit our debtors control. Debtors control to say we are reducing this account, right? So our sales, it is an expense, so it was actually decreased this time. It was decreased, owner's equity, it was decreased, right? And then our debtors control, it is an asset which was as well as decreased, right? Because of this person retaining the stock, right? So we are not done. We have two more accounts which are affected out of this 4. We have the cost of sales and the trading stock. Trading stock is also an asset account, plus, minus, right? Debit, credit, right? So since this person has returned stock, what is happening to our stock? Our stock is increasing. So therefore we are going to debit our trading stock and credit the other one. Double entry principle: when we debit one account, we credit the other. So therefore it would be debit trading stock, right? Debit trading stock, and then we would credit what? We would credit our cost of sales. Right? For how much? We are going to use the cost of sales price, which is 300 rand. So you're going to use that 300 rand and say, okay, my trading stock, it is an asset and it is increasing, right? And my expense also is also actually increasing, because remember that this is actually an owner's equity, so it's minus plus, since we are crediting it, right? So you have to take the sign, right? So I hope you can see that usually we take the signs of those T accounts. When you draw that T account and say this is an asset account, for you to be able to show the effect on the accounting equation, just take those signs, right? So we are done with number 3, right? So this is number 2. Yes, we are not done with number 3, we are done with number 2, right? So let's get to number 3. Okay, so for number 3, you are being told to adjust the provision of bad debts to 6%, right? And so far I have actually taught you that for you to be able to calculate the provision, you need your debtors control, right? We need our debtors control as well as the percentage of the provision, right? The percentage of the provision. So to calculate the provision on bad debts, you say your debtors control. Your debtors control is actually what is 24,100, but you need to adjust it because you were given the adjustments here which were not recorded. The first one was when this particular person did what? When they couldn't pay, right? A portion of this amount was not paid, right? And we took it to bad debts, decreasing the debtors control account. So the portion here, we calculated it to be what? To be 300, right? So therefore, you would actually do what? You would actually say 24,100 minus 300, right? Minus the 300, right? You also have to minus what? To minus the 200 rand. You also have to minus this 200 rand because it is decreasing this debt, okay? Because it was paid up. When something has been paid up, it is decreasing that particular debt, right? So the 300 is one that we had to actually do what? We had to actually write it off. And then the 200, it is what we actually received, right? And then for transaction number 2, right, of the 800 rand, we know that debtors control, it is affected by sales, okay? So for debtors control, you take the selling price. When we had a credit sale, we increased our debt, okay? So therefore, this will be a plus 800, right? And then we had a debtors allowance, meaning stock was returned, decreasing this credit, right, by how much? By 400 rand. We always take the cost, the selling price when we deal with the debtors control, right? So therefore it is what? It is 400. So therefore you have to minus and say, when this person returns stock, they actually reduced their debt because we even allowed this and issued a credit note, okay? So what will be your total debtors control? It will be 24,100 minus 300 minus 200 and then plus 800 minus 400 to give you what? To give you 24,000. So therefore your debtors control is sitting at 24,000, right? And then that's where you can now time it by the provision of bad debt. Okay, so the provision, you say time is 6%, it'll give you 1,440. Okay, 1,440, right? So therefore your provision is 1,440. You should adjust it to this amount, right? But now what is the existing provision that we have? It's actually 2,000 rand. Okay, so the existing provision is actually 2,000, right? And we need to decrease it, right? So when you decrease something, it becomes what? It becomes an income, because we are going to take a portion of this money back into the business, right? So 2,000 minus 144 will make our provision for bad debts adjustment income of how much? 2,000 minus 1440, it is 560, right? So it is 560. So this will be an income because we are taking it out of this account to say, yeah, so we are reducing this account. So since it is a decrease when you compare to say the existing provision that we have is 2,000 and the adjusted provision is 1,440, this means that I need to decrease it, okay? Decrease it to this amount, okay? From this amount to this amount is a decrease, right? So if it is a decrease, it is an income at all times. It is an income, right? So therefore, two accounts are affected whenever that you have to adjust that provision. Is your provision for bad debts adjustment, and in this case it is an income because we are decreasing the provision as well as provision for bad debts, which is an asset. Okay, so it is an asset, right? So it is 560. So we know that incomes are credited, expenses are debited. So therefore, this is going to be what? This is going to be credited, this is going to be debited, right? So therefore, you'd say your provision for bad debt, which is an asset, provision for bad debt, and then you have what? Your provision for bad debt as well as your provision for bad debt adjustment, which is an income. So how much is it? It is 560. Okay, so you take the amount which you need to adjust that particular provision with. So if you need to adjust it by 560, you're going to take 560, not what you just calculated, 1440, right? So haunki enana, but onka e lorang also is subtractile, right? So it's 560, right? So it will be 560 and say, okay, my provision for bad debts, right? It is what? It is an asset, a negative asset. And therefore, in this situation, it means it's going to be a plus, right? It's going to be a plus on our debtors control, okay? And then provision for bad debts adjustment. This is an income. We know that when we had to decrease it, this is going to make it an income, right? So therefore, it will be a plus here because it is in owner's equity. Incomes are owner's equity, and then it will be a 0 here, right? So that is our accounting equation. I will just do the other accounts just now.